Transferring equity in a Chinese company. Don't get caught out by taxes. This quick guide breaks down what you need to know. K-tax, income tax. The main tax is income tax. For non-resident companies, it's typically 10% on the capital gain. For individuals, it's 20%. This gain is the difference between the transfer price and the original investment cost. Taxable events. Taxable events including direct equity transfers and also indirect transfers, like selling an overseas holding company whose main asset is the Chinese equity. Tax calculation. Taxable income equals to transfer price minus the original investment cost minus reasonable expenses. It's crucial to accurately calculate your original investment and keep detailed records. Withholding obligation. The transferee, the buyer, has the legal obligation to withhold the tax and pay it to the Chinese tax authorities. Tax filing. The transferor, the seller, must file tax return to declare the income. Even if the tax is withheld, filing is still required. Required documents. Prepare this document: equity transfer agreement, proof of original investment, identity document of both parties, tax registration certificates, and any relevant approvals. Tax treaty benefits. If the transferor is from a country with a tax treaty with China, they might be eligible for a reduced tax rate or an exemption. Check the specific treaty terms. Challenging taxable price. Chinese tax authority has the right to challenge the declared transfer price if it's deemed too low. Assets valuation report. In such cases, they may require the transferor to provide an assets valuation report from a qualified valuation firm in China to justify the price. Selecting valuation firm. Choosing a reputable qualified valuation firm is crucial. The report must be detailed, objective, and comply with Chinese valuation standard. If challenged, be prepared to provide all supporting documents, explain the valuation methodology, and potentially negotiate with the tax authority. China has a strict anti-tax avoidance rules. Structuring transactions solely to avoid tax is risky and can lead to penalties.